Hello friends, happy Sunday. Let's continue with stock option strategies. Today we'll be talking about covered calls and the various formats of doing option trades. So these are the various formats of doing the option trades: naked calls and puts, which you normally do. You just buy the calls or you buy the puts and sell them for gains, or your stop losses hit. Then the next one is selling covered calls. This is what I'm going to speak more in this particular session. There are various spreads that you can do for options. The spreads also reduces your risk. That is call debit spread, call credit spread, put debit spread, put credit spread. So don't worry about these names. Once you understand one of them, it will be very easy to understand the remaining three. The next one is iron condor. Next one is calendar spread. The one I have not mentioned here is a strangle. Strangle means buying a call and a put together. For buying a strangle, you should when you buy a strangle, you always think that next day or next session the stock is going to move very high, maybe on the upside or the downside. Then only you will get profit on the strangle. In this session we'll be talking about selling the covered calls. There are a lot of books the authors have written, and the authors are saying that selling covered calls is the best strategy for beginners. Selling covered calls, it safeguards your capital, okay, and the risk is 42% lower. I will be talking about these in the next slides. So the first step is you need to buy 100 shares of the underlying stock. Then what you do is you sell a call option. The strike you might choose is 5 to 15% depending on the expiry. If you're choosing the same week expiry, you should choose 5 to 7% above the strike price of the call option, above the spot price. For example, I have also mentioned an example over here. If you are choosing, say, suppose 2 or 3 weeks ahead, you can choose 10 to 15% ahead call option to sell it. So once you sell that call option, you keep that money and you collect that money. That's called credit. So that money is credited in your account. So I've given an example over here. Suppose our ABC stock is at 100. You purchase 100 shares and then you sell a call option of 105 of same week expiry. Maybe I'm doing it on a Monday. Okay, so the expiry will be on Friday. I have 5 working days in between. Yeah, so in the next slide we'll show you the how to gain profit. Step 3 is how the step 3 and step 4, what are the chances of getting profit by selling covered calls. The first the first scenario is the ABC stock, it remains range bound, or it remains up to less than 105. It um, your call option, the stock remains less than 105 at the time of expiry. So your call option expires at 0. All call options out of money will expire at 0. I have already told in previous session. So now it is at 0. You no need to buy it. So what happens is you whatever you collected, that $250, you just keep it. Suppose your stock is at 104.9, bit less than 105. So now you can sell your stocks also. So the total profit you get is 100. You collect 4.9 on the stock, that is $490 on 100 stocks, and you collect whatever you collected 250 by selling the call option, you keep that. So your total profit is 740. If you just bought the stock and if you just sold at 104.9, your profit would have been just 490. But with selling covered calls, you have increased your profit to around $740. So this is the best scenario of getting profit. If the stock is above 100 but less than 105, you gain more profit than you could have got by just keeping shares, by just trading the shares. The next option, if the stock rises very high, suppose it crosses your strike price of 105, suppose the stock is now at 110. Okay, so I'll show you in the next slide. Now the stock is at 110 at expiry. Your call option will be 2.5 plus 5, because the the ABC stock has moved above 105 to 110, so $5 it has moved over there. I'm just doing this calculation without even considering theta. So then when you sell your share, when you buy your call option, you square off your call option, what you lose, because you're buying at 750, but you collected 250, so you lose 500. But by selling your stock, you you are selling 100 shares at $10, so you gain 1000. So your total gain is 1000 minus 500, that is $500. That is your, that is the minimum gain in this category. But because of time decay, the call option won't be at 750, it will be somewhere around above 5.5 or something like that. So your profit would be something near 700 or more. Okay, so these are two scenarios. The third scenario, if the stock falls heavily, uh, you collect whatever you collected by selling the call option, that you keep that money. Okay, but by uh, but your stock goes in red and it will remain in red. You can just wait for some time for the shares to come back, to come up, to recover, and once it is above 100 you can sell them. Or you can keep doing, because you have 100 shares in your account, you can keep doing the covered call, selling covered call options for next week and further. So you can keep doing that. So this is one way. Or you can follow stop loss. This in this trade, by selling covered calls, the stop loss is very well defined. Whatever money you collect on selling the call option, that is your stop loss for the stock. So if you collected 2.5 by selling the call option, so your stop loss will be 100 minus 2.5, because the stock was at 100, minus 2.5, 97.5 on the stock. If the stock goes less than 97.5, you sell your stock, as well as you buy the calls, means you square off your calls. So in this scenario, excuse me. So in this scenario, uh, your call option, the buying price might be $20 to $30. That's it. That is all you lose. So you just lose $20 to $30. Your remaining capital is safe in your account. You sold the stocks also, you're out of stocks, you're out of options by just losing $30. Chances of hitting that is also even very low. Chances of stock going to 97.5 or less and hitting that stop loss is very low, compared to if you do that naked calls. If you buy at 2.5 and it goes 97.5, you lose whole 2.5. It means you lose around 2.2, you lose $220. Instead of if you do covered calls, you just lose $30. If you do naked calls, and if stock falls, you lose around above $200. So this is the difference why people use covered calls, or people say covered calls is better for beginners. Similarly, you can do covered puts also. For covered puts, in your account it should have enough money to buy that shares. So if the shares rise, so in this case, if the share rise, your puts lose, and your puts they become zero. You know, whatever, let the share rise to by 50%, no problem. If the share rises by 50%, you just have money in your account, you don't have any shares. So you just square off your put which you sold, which you sold, and you keep that money. uh, that's all. That's all, you're done with that trade for covered puts. Yeah, if the stock loses very heavily, then you need to buy those stocks at a lower price, and also you need to square off your puts. So covered puts is not so popular as covered calls, because risk is bit higher in covered puts than in covered calls. Now, the benefits of doing covered calls compared to buying naked options, the risk in covered calls is 42% less, or I would say the chances of getting profit is 42% more in doing covered calls. Okay, if you buy a stock, what will the stock do? The stock will go up, it can go down, or it can remain range bound, or it can remain flat. So these are the three scenarios that will happen if you buy a stock. In case of covered calls, what is this sorry in case of naked calls, you just bought a call of 105, say suppose for ABC. What is the scenario for chances of profit? The stock goes up. That is the only scenario. The remaining two is not good for the buyers of naked calls. So the chances of profit is 1 by 3. There are three scenarios, but chances of profit is only in one. Seller of covered calls, there are profit scenarios. If the stock goes up, you gain. If the stock is flat, you gain. If the stock goes down a bit, then also you gain. So these are three chances of gaining. The chances of losing, if the stock goes down heavily, then you lose. Okay, so out of four scenarios, there are three scenarios which gives you profit. So the chances of profit is 3.3 by 4, which is 0.75. Now if you do the math, chances of profit for covered calls is 0.75, chances of profit for naked calls is 0.33. If you subtract 75% from if you subtract 75 minus 33, it will be give you 42. So 42% more chances of getting profit with covered calls. Now if you follow stop loss, that is even better. You no need to get stuck into the stock. Clear and defined stop loss. You no need to guess, you no need to do any guesswork, or any people are doing that Fibonacci series and all, trying to find the stop loss. No need to check candles and all. It's a very well defined stop loss for covered calls. Why not covered calls? The disadvantage, you need to purchase you need a lot of capital to purchase 100 shares, and if the stock falls heavily, you need to wait longer for it to recover, or you need to use your stop loss. So these are issues with covered calls. A lot of books have been written on covered calls, and all authors are claiming that selling covered calls is a profitable way. So that's all I had for this session. Next session I'll be talking about a spread. A spread is a very interesting thing. It also reduces a strict risk compared to naked calls. So that's all I have in this session. Thank you for watching. Good day.